Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a topic that is a slightly more advanced strategy with respect to options, and that's selling credit spreads. But it is a very useful strategy, and many traders love this strategy because it generally has a much higher probability of profit than most other option strategies, meaning that even if all things are the same strategies with poor risk to reward and better probability of profit, people tend to prefer strategies with higher probability of profit. So today what we're going to do is we're going to break down the strategy. But before we do, I'm going to actually first make sure that everyone understands when you should utilize this strategy, because this is a strategy that you shouldn't use all the time. You know, I tend to find that some users will always sell credit spreads or always trade certain strategies. And it's important to know when option strategies are suitable and when it's not before you decide whether this is a strategy suitable for you. So then we're going to discuss when is the right time to utilize these types of strategies. Then we'll break down the strategy itself so you have a better understanding as to how they work. And then lastly, we'll talk about the optimal strategy, meaning what type of expiration dates and strike prices should you use for this type of strategy, and try to give you a few examples so that you understand how to utilize this type of option strategy. So let's go ahead and get started. Before I do, just a quick disclaimer: what we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So first, we want to talk about when. Most of the time when we talk about these types of strategies, we talk about what is a credit spread. But before we discuss what, I want to discuss when should you use a credit spread, because you're typically looking at the security first before you look at option strategies. So when you're looking at underlying stocks, when you're looking at the overall market, it's important that you first know when you should utilize this type of strategy before you take a look at what are credit spreads. Then we'll talk a little bit about optimal credit spreads and how to manage these credit spreads once you're in those specific trades. Now, credit spreads, like I said, is a more advanced strategy because it takes a little bit more understanding of the strategy and understanding of how to trade these strategies before you can manage them. There are a lot of contingencies, if you will, in terms of the strategy, meaning you, depending on this, then that type of contingencies. We'll discuss what those things are and how to manage credit spreads, and then we'll try to go through a few examples to try to make this as concrete as possible. And then at the end, we'll do questions and answers so that you guys can ask questions regarding what you've learned here today. So let's go ahead and get started. Now, the main question that I want everyone to be able to try to walk away from here today is, how can I maximize an income or the income that I receive on a credit vertical spread? So even if you're brand new to options trading, I will do a brief introduction to credit spreads so that you can understand how they are constructed. But if you're brand new to options trading, I do recommend that you go over the beginner's options course first before you come back and watch this recording. I think you'll find a lot more value in this particular webinar if you first go through the beginners webinars on buying and selling options, because a lot of the things that we're going to talk about here today are built on those foundational topics. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. My career really started as a technical analyst in currency trading. So for those of you that trade currencies, you're probably familiar with trading using the charts. So today we're going to heavily use the charts to help us determine when is the right time to utilize a credit spread. And then we'll talk a little bit about the optimal option strategy once you identify an opportunity to sell credit spreads on. So at this point, what I want to do is have everyone bring up your chat window, which is at the bottom of your screen. Click on the chat window and bring it up. And I just want to make sure everyone can hear me loud and clear. So please type yes into the chat window if you can hear me loud and clear and you can see my screen. Okay, perfect. I see all yeses. Great. So let's get started. And first, like I said, what I want to cover is when should you use credit spreads? And this is important because credit spreads are only useful for very specific market conditions. They're not useful in all market conditions. We usually think about these spreads as directional trades, meaning when we have either a bullish or bearish view on an underlying stock, but credit spreads are specific for a specific type of directional view, specifically when a stock is or a market is trading near a support or resistance level. The reason I say support or resistance level is because when we identify a support level, that in itself does not actually mean, so when a stock approaches its support level, that doesn't in itself tell us how far the stock is going to move. So many times we have to rely on other forms of analysis, perhaps our fundamental view, perhaps our view on economics, our view on the broader market, to determine, well, do we think now that it's bounced off support, is it going to bounce a little bit, a lot, or just a marginal amount? So when a stock is near a support or resistance level, what you're able to generally tell is that the markets are going to reverse. Now, that is usually a good time to utilize credit spreads. Now, if you think the stock is going to reverse huge, then you might want to use other strategies. So we'll talk a little bit about this, but the other type of time that you might want to use a credit spread is when the stock or asset is overbought or oversold. So if you're using an RSI indicator, when it's oversold or overbought, these are generally ideal conditions to sell a credit spread. When it's oversold, you want to sell a put credit spread. When it's overbought, you want to sell a call credit spread. So those are generally speaking the type of conditions that you want to sell a credit spread in. The other one is really when a stock is trading within a certain range. Now, markets haven't really been range bound much recently, but they were range bound about a month ago here when the markets were trading within a pretty tight range. So whenever you identify the markets are trading in a specific range, when it's at the top of the range, you might sell a call credit spread. When it's at the bottom of the range, you might sell a put credit spread. And we'll talk a little bit about what a call and put credit spread is, but it's important that you understand that credit spreads are useful when you identify a reversal. So whenever you identify a stock is going to reverse its direction, but you don't believe that the stock is going to make a big move. If you expect the stock to make a big move, then you're better off buying a call when it's bullish and buying a put when it's bearish. However, if you think that the move is going to be relatively small, right? So you think it's going to bounce a little bit, but you don't think it's going to go a whole lot, or maybe you think it's going to go sideways, those are the best opportunities to sell a put or call credit spread. So generally speaking, when you expect a small directional move, but again, all of these different types of technical indicators are useful in helping you understand that there's going to be a switch in terms of the directional move, but you don't necessarily expect that move to be a huge amount, or also in high volatility environments. So volatility right now is still remaining fairly elevated. These are ideal conditions to sell credit spreads, especially when volatility is high, but it's not extreme. So when at extremes, those are sometimes difficult times to sell volatility. But when things are high, but it's not extreme, this is really the best environment to be selling credit spreads or selling options in general. And today we're talking about credit spreads because credit spreads is one of the ways that you can sell volatility and sell time decay without taking on unlimited risk, because that's the biggest challenge with selling options, is that you're taking on a fair amount of risk when you're selling options. So credit spreads allow us to do so with limited risk. So now that we've discussed when you should use credit spreads, now let's take a look at the credit spreads themselves, and I'll start off with the basics. I'll start off by just talking about buying a call and selling a put as a bullish strategy and show you how a credit spread builds on top of that. So here I have OMX S30. Now, OMX S30 recently has taken a pretty big move to the upside. Today, we had some pretty weak price action, and it's about to break its 20-day moving average. So perhaps we might have a bit of a pullback here in the OMX S20. Now, again, most of this pullback right now is due to the risk that we currently see with the second wave of the coronavirus. We've seen an influx in cases in many countries, especially countries that have in theory passed or flattened the curve and is clearly on the decline, but have seen increase in terms of cases. We've seen this in the US, we've seen this in Europe, we've seen this in Latin America. So a lot of concerns right now. Now, as far as how far can the market pull back, that's the question. As far as my perspective, I don't think the markets are going to go a full-blown sell-off like we had back here in February, but I certainly think that we're going to perhaps get a pullback into that 1550, 1500 range on the OMX S30. So a bit of a bearish view here. Now, that's my base case. However, if markets continue to move higher, if you have an opposite view and you think markets are going to go higher, we're going to look at both cases here. We're going to look at both bullish and bearish views, and we're going to show you how you can sell a credit spread for either one. So let's first cover the bullish side, right? So markets have moved substantially higher over the past month, and for the most part, every single time it reaches that 20-day moving average, it generally finds support. And many times it breaks a little bit below it and then continues to move higher. So let's just say that that's our base case, and we think that this market can continue to move higher. So as an options investor, you have two possible choices as a beginner's options investor. Number one, you can buy a call option. That's the simplest strategy that you can trade if you're bullish on an underlying stock or market. So here, what I'm pulling up here is a July 1660 call option, which is the at the money call option, and it's currently trading at about 48.5 crowns. I'm also looking at a July 1616 put, which is also trading at 48.5 crowns. So what we're going to explore are two strategies. One, I'm going to buy a call option, which is a simple bullish strategy. And what I'm also going to do is select selling a put option. Both of these strategies are considered bullish, but as you can see, they're quite different from each other. And this is really one of the important things to learn about options trading, is that when we think about buying a call option, sometimes we think of that as a bullish strategy, and we think about selling put as a bullish strategy, but they are quite different. And the difference here is that when you buy a call, you have to pay the 48.5 crowns to buy a call option. Now, what that means is that not only does the OMX S30 needs to go up in order for you to make money, the OMX S30 needs to go up by the amount that you pay for the call option, which in this particular case is 48.5 crowns. So what that means is that your break even on a call option is actually 48.5 crowns above the current price. So basically, what that means is that if you want to buy a call option on OMX S30, not only do you have to believe that the stock is going higher, you have to believe it's going to go higher by a certain amount. And that certain amount is dependent on how much that call option costs. So by the July expiration, you have to believe that OMX S30 will be above 1708 by expiration in order for it to make sense. Because if it's not above 1708, you're actually going to lose money on this specific strategy. So that's the biggest challenge with buying a call option. Now, on the flip side, you can sell a put option. And the benefit here when you're selling a put option is that when you sell a put option, you are actually collecting the 48.5 crowns. So when you sell a put option, what you basically need the stock to do is stay put or move higher. But because you've collected 48.5 crowns, you get a buffer. You get a buffer of 48.5 crowns, which means your break-even price, instead of being 48.5 crowns above the current price, your break-even price is actually 48.5 crowns below the current price. So your break-even here is 1611.5. So as long as OMX 30 stays exactly where it is, so either it moves sideways, higher, or even if it moves a little bit lower, you can actually still make money on this particular trade. Now, if OMX S30 is below 1611 by expiration, that's when you lose money. So many people will say, well, why would I want to trade an option that is going to require such a big move in order for me to make money versus selling a put option where even if it stays put, even if it goes down a little, I could be wrong on the direction and still make money. Why would I ever buy a call option? Why wouldn't I just always sell puts? And the downside to selling a put is that when you sell a put, you have unlimited risk, right? So when you buy a call option, you have unlimited reward and your max risk is capped at the amount that you pay. So no matter what happens, so if you buy a call option and OMX S30 drops, you're limited to just 48.5 crowns in terms of losses, no matter what happens. Even if the index goes to zero, you only lose 48.5 crowns. Now, when you sell a put option, the exact opposite. Your max risk here is unlimited and your max gain is capped at 48.5. So the risk to reward here basically flips, right? So you're basically trading off for the fact that the stock needs to make a big move when you're buying a call option with limited risk to giving you a much bigger buffer when you sell a put, but you're taking on more risk because if the index continues to fall, you're going to lose more and more money. Just like if you bought the index, if you bought the stock if the stock continues to fall, the further it falls, the more money you lose. That's the same risk profile that you take when you sell a put option. So it's important to understand the difference between these two before you start exploring options. So does this make sense, everyone? Please type 1 into the chat window if the difference between buying a call option and selling a put option here makes sense to you. Perfect. I see a lot of ones. Okay, so we've discussed the challenges of buying a call option, and we discussed how you can improve it on our last webinar on how to maximize your profits using debit spreads, because debit spreads are really just taking this strategy and improving it by reducing your risk and potentially increasing your potential reward. So today, what we're going to explore is by selling a put option, you have a much better or much more favorable trade, because even if the stock goes higher, if it goes sideways, or if it goes lower by a little bit, you make money in all of those scenarios. The only scenario that you lose money is if the stock drops significantly. So from a probability perspective, selling a put option will result in profits far more often. But the problem with selling a put is that you have unlimited risk, and no one really wants to take on unlimited risk. So the reason that we want to sell credit spreads is to allow us to take exposure that looks like this, but do so in a way without having to take on that unlimited risk. So that's what really a credit spread is doing here. So what you're doing here is you're still taking this bullish view here in OMX S30, but especially when you have a more mild bullish view here, what you can do here is we can sell the 1660 put and collect the 48.5 crowns that we were talking about. But remember, we said that if you sold the put, yes, that's a pretty high probability trade, but if the trade goes against you, you're taking on unlimited risk. So what can we do to take that bullish view, but do so in a way with limited risk? What you can do is you can actually buy a lower put. So what you can do is you can sell the 1660 put and then buy, let's say, a put that's out of the money here. I've chosen a strike for you. I'll show you in a few minutes as far as why I chose that specific strike. But let's say I buy a 1585 put for 23.5 crowns. Now what happens is my net credit on this, because I receive 48.5 in terms of a credit for selling this put, and then I have to pay 23.5 crowns for the put. My net credit, instead of being 40.5, is now reduced down to 25. But by doing so, what happens is I reduce my risk from unlimited to down to just 50 crowns. And we'll talk a little bit about how we come to that number here in a second. But the reason that we want to do this is because we want to take on a credit, but we want to do so in a way with limited risk. So we can do that by buying a lower put, so that even if the market does crash, right? What happens is, yes, I'll lose money on my short put, but whatever money that I lose, I will start to gain back below 1585 because I own a long put. So the two basically offset each other for any losses below 1585. So even if the stock goes down to, even if the index goes to 0, the most I can lose is 50 crowns. Now, how did I get to 50 crowns? What you have to do is you have to look at the distance between the two strikes. So the distance between these two strikes is 75 crowns, right? So if you take 1660 minus 1585, the difference between that is 75 crowns. So whenever we talk about vertical spreads, the distance between the strikes is really the amount of capital that's at play. So if we collect 25 crowns out of the 75, the remaining 50 is our max risk. So whenever we're selling a credit spread, our goal is to try to collect as much credit as possible, because here, whatever I collect, the rest of it is going to be my risk. So if I'm able to actually do this in a way where, if let's say I'm able to collect, instead of 25, if let's say I'm able to collect 30 crowns, then my risk actually goes down to 45 crowns. So for every crown that I increase in terms of credit, the risk actually goes down. So you have this magnifying effect. So when you're selecting a credit spread, what your goal here to do is to try to increase your max reward or your credit as much as possible. And there's two ways to really do this: is seek strategies that have a relatively high income that you receive, and then select put strikes that are relatively cheap to purchase. And if you do that, what you're really going to do is maximize the risk to reward. because the total that's at play, you can't change. You can't change the 75. But what you can do is try to seek strategies that give you a certain amount of income that offsets the risk that you're taking. So the break-even price now, before the break-even price was 16.11. Now your break-even price is a little worse. It's at 16.35, but still, you're in a scenario now where if OMX S30 goes higher, if OMX S30 stays sideways, or if OMX S30 declines to 16.35, in all of those three scenarios, you make money on this trade. The only time you lose money is if the index drops. But no matter how far it drops, no matter what happens, you're only risking 50 crowns. So that's how a credit spread works. Now, does that make sense to everyone? Please type 2 into the chat window if that makes sense to you. Okay, perfect. Great. So the key here to remember is the fact that you want to sell a put option because that gives you a very, very good outcome potentially, as long as OMX stays the same, moves higher or moves a little lower. But because that unlimited risk factor, what you're doing is you're buying a lower put to offset that risk. You're going to give up a little bit of income, but what you gain for that is limited risk, so that you can control how much risk that you have on this specific trade. Okay, so next, let's take a look at the bearish view. So this is basically the exact same thing, but flipped on a dime. So we're going to go through this. So let's say now you think that OMX S30 is going to decline. Maybe you think it's going to decline a little down to maybe 1550 or so. You don't think it's going to make a big move to the downside, but you think that momentum is starting to shift lower. Things are going to start moving lower here. So what you can do as an options trader, first of all, for the simple options traders, you might just simply buy a put option. So here, buying a 1660 put costs that 48.5 crowns that we discussed. Or as a more advanced strategy, what you can do is you can sell a 1660 call. Now, just like the calls and puts that we discussed before, when you buy a put, you have to pay that premium, which means that your break-even price on a put option here is that now your break-even price is 16.11 because you're paid that 48.5. So the index needs to move down to 16.11 just for you to break even. So you have to really believe the index is going to make a big move to the downside in order for it to make sense to buy your put. And this is one of the challenges, because whenever you think about buying a put option, or whenever you are bearish on an index, it doesn't mean that you think the index is going to move by 50 points lower by your expiration date. Sometimes you think that it's going to move lower, but you don't think it's going to move lower by very much. And the only other strategy that you can do in that particular case is selling a call. So when you're selling a call here, you're collecting that 48.5 crowns. So now your break-even price is 17.08. So as long as the OMX S30 stays below 17.08, you're going to be profitable on this trade. And that means that even if OMX S30 moves sideways, or even if it moves a little bit higher, all three of these scenarios, you're going to be profitable on this strategy here, versus when you buy a put option, you have to have a big move to the downside in order for you to be profitable. If you bought a put option and the stock moved sideways, or the index moved a little bit higher, you're going to lose almost all of the money that you paid for that put option. So now, one of the challenges here again is that obviously for many users, they'll say, well, this seems much more attractive, right? Because in all three scenarios, I'm going to make money. Here, I need one very specific scenario to make money. But the trade-off here is that when you buy a put, you have max risk of 48.5 crowns. No matter what happens, even if the markets turn around and rally significantly higher, you're only risking 40.5 crowns. Now, what's really challenging about selling a put option is that selling a call option is that you truly have unlimited risk. Because when you sell a put, the index can't go below zero. So there is a finite amount as far as how much money you can lose when you sell a put. But when you sell a call, there's no limit as far as how far the index can go. The index can keep going higher and higher and higher. And the further higher it goes, the more money you lose. So this is truly a strategy that, generally speaking, you don't want to take naked because of this unlimited risk. And you certainly don't want to take on that risk just for 48.5 crowns, right? Because 48.5 crowns is not a whole lot of the index value. And if you can take on thousands and thousands and thousands of crowns of risk, that's really not worth it. So that's why we want to take a look at credit spreads. So in the same example here, let's say I have a bearish view here on OMX S30. So what I'm going to do is I'm going to sell that 1660 put. I'm going to collect 48.5 crowns, but because I don't want to take on that unlimited risk, I'm going to buy a 1730 call against it. For this particular case, this was based on prices a couple of hours ago. I would have paid about 17.5 crowns to buy the 1730 call, which means that my total cost of this single trade, or my total income that I received, is 31 crowns. Now, when I'm trading this, now notice how the distance between the two strikes here is 70 crowns. So by buying that 1730 call, what I'm doing is I'm basically hedging my bets so that if the market, if OMX S30 really rallies, right, above 1730, I don't take on any additional losses above 1730. So I no longer have unlimited risk. My max risk is now just defined to 39 crowns. So my max reward here is 31 crowns because that's what I've received in terms of credit. My max risk is the difference between the distance between the two strikes, which is 70 minus the 31 crowns that I collected on income. So my max risk is the remaining amount of 39 crowns. So now my break-even price, instead of being 17.11, is now roughly 16.99. So not as good, but still pretty good here, because if OMX S30 declines, if OMX S30 moves sideways, or if OMX S30 moves up to 1700, all three of these scenarios, I'm going to be profitable. The only time I lose money is if OMX S30 really rockets higher. So this is really how you can utilize, I really think of this as credit spreads and debit spreads. This is really just the beginning of learning how you can combine options together to get the exact payoff graph that you're really looking for. So regardless of what you're looking for, you can construct options together, buying and selling. You can even buy and sell different expiration dates. You can buy and sell different strike prices to really construct the payoff that you're really looking for, depending on what your outlook on the stock is. And debit and credit spreads are really just the first step that you take in learning how to construct different strategies together to give you the payoff graph that you're really looking for. So credit spreads are a really versatile strategy to allow you to sell premium. And I know a lot of you like to sell options. So credit spreads allow you to maintain that selling options, but do so in a way with limited risk, because that's really the biggest challenge with options, is the fact that you're taking on unlimited risk when you're selling an option. So does that make sense, everyone? Please type 3 into the chat window if this makes sense to you. Someone said that the break-even is 1691. Oh, you're absolutely right. So there is a mistake here. Very keen eye here. The break-even here is technically 1691, which is 1660 plus the 31, which gives you 1691. So very good on that, very keen eye. I apologize for that mistake there. So now that we understand how to construct a strategy, let's talk a little bit about the use of this particular strategy in your portfolio. Number one, we consider this, we call it a very forgiving strategy. And the reason I say this is because you can actually get the direction wrong and still make money, right? So in the previous example I was showing you, we took a bearish credit spread, but even if the index moved up a little bit, I can still make money. It's a very forgiving strategy from that perspective, but it is a strategy that's generally useful only for mild or neutral views. And the reason I say this is because if you are bearish on OMX the S30 and you think there's going to be a big move lower, what you don't want to do is sell a credit spread, because the credit spread caps the risk, the reward that you can make. So here, no matter what happens, even if the index goes to 0, you're only making 31 crowns. That's it. So if you really think the stock's going to make a big move, you're better off buying a put option, because a put option limits the risk that you take and gives you unlimited downside. So if the stock continues to move lower and lower and lower, you make more and more money. So that's why it's very important that you understand that when you're selling a credit spread, It's only useful if you think it's going to make a small move. If you think it's going to make a big move, there are better strategies for it than selling a credit spread. Does that make sense, everyone? Please type 4 into the chat window if that one point makes sense to you, because that's a very important point when you're learning about credit spreads. Okay, so generally speaking, when a stock is near an overbought or an oversold condition, based on different technical indicators, so if you use a momentum indicator like RSI or MACD or stochastics, these are all good indicators to tell you that a stock's momentum is reversing. The thing about these overbought or oversold conditions is that the reversal itself only tells you the direction is changing. It doesn't tell you how far the stock's going to make a move. So that's why credit spreads are ideal when you get these overbought or oversold conditions, because that's telling you that the direction is starting to move in a different direction. That is the best time to sell a credit spread. You can also use tops and bottoms, so double tops, double bottoms, or if a stock is near a support or resistance level. These are all chart patterns that tell you that the momentum or the direction of a stock or index is now turning around. Those are your ideal times to sell a put or call credit spread. And again, lastly, do not use them when you're expecting a large and fast move. If you think it's going to have a large and fast move, you want to buy a call, you want to buy a put, or you might want to trade a debit spread. Those are the better strategies when you do expect a big and fast move. Now that we talked about the strategy itself, now we've talked about the bullish strategy and we've talked about the bearish strategy, one thing I do want to point out here is that you can sell a put vertical when you are bullish, and you can sell a call vertical when you are bearish. So notice how that's the exact opposite, right? Normally we associate calls with the bullish strategy and we associate puts with the bearish strategy. But when we're selling premium, when we're selling credit spreads, this is the exact opposite. Calls are for bearish, puts are for bullish. So one of the things I want to point out here is that puts have an edge over calls. And I want to explain this to you in a little bit so that you understand why that's the case, so that when you're thinking about these types of opportunities, you want to know that puts many times will give you a slight edge over selling calls. And the reason for this is because when we sell puts, it's usually because the market is near a bottom and we think that these puts are going to reverse higher, right? So at this point is the best time to sell a put credit spread. Now, if you think about it, at that point, the market or the stock has already dropped a significant amount to reach to that point. So usually what happens is when you're at that point, the implied volatility of an option is already elevated when the stock has already fallen. So after the stock has fallen, the implied volatility at this point is usually relatively high. And what you're playing for is that bounce higher. Now, usually when a stock bounces higher, or when the market bounces higher, implied volatility lowers. So keep in mind that whenever you're selling options, you're short volatility. You want volatility to actually go down. So when you're selling a put credit spread, you're selling it when volatility is high. And then what you're doing is you're hoping to buy it back later when volatility is low. So put credit spreads really take advantage of this, because as you're selling when volatility is high. And then when you get the movement that you're expecting that it's going to happen, volatility will contract. So not only do you have the trade working in your favor, you also have this volatility edge when you're selling a put credit spread. Vice versa, when you're selling calls, it's the exact opposite. When you're selling calls, you're selling it when the stock has already reached a high level. That's when implied volatility is actually at its lowest. So you're selling vol already when it's low. And then when you're expecting that reversal down, what happens is volatility is actually going to increase. So what you have is volatility actually working against you, even though the trade is working in your favor, but the volatility component of the trade is working against you. So that's why when you're selling credit spreads, puts will give you a small edge over calls, because puts have volatility working in your favor versus call credit spreads have volatility working against you. Now, this factor is not huge. This shouldn't necessarily change your directional view on an underlying stock. It's just important to understand some of the nuances here when it comes to selling credit spreads. So does that make sense, everyone? Everything here on this page, please type 5 into the chat window if this makes sense to you. Okay, perfect. I see a lot of 5s. So now one of the fundamentals of understanding credit spreads is the fact that you really have this trade-off between probability and risk to reward. And this is true for all strategies. This is not just credit spreads, but it's really important to understand that when you're trading options, you're always trading off 2 things, risk to reward and probability. So certain strategies have very high probability, and what that means is that you have really poor risk to reward. Other strategies have very low probability, but then have very high risk to reward. So it's important to understand that when you're selling credit spreads, these are strategies, whoops, there's a bit of a typo here. It's important to understand when you're selling credit spreads, these are strategies that have high probability of profits. And then what they have is very relatively poor risk to reward. Because when you're selling a credit spread, as we said, you know, even if the market goes in the direction that you expect it to, if it just goes sideways, or even if it moves a little bit against you, you make money in all of those scenarios. That's why it's a high probability of profit reward, a strategy, because you can have a lot of different outcomes and all make money in those outcomes. And it's only when the stock really goes against you when you lose money. So this is a strategy with relatively high probability of profit. Usually you'll see somewhere in the 60 to 70% probability of profit on these types of trades, but they usually have very poor risk to reward. Just like the examples that we showed you before, we're risking 25 crowns to make 75, risking 50 crowns to make 25 crowns. Your usually risk to reward is pretty poor. You're risking usually double the amount that you're actually collecting in terms of income. So it's important to understand that this trade-off that you're making when you're selling credit spreads, yes, you're going to be profitable more often, but when you're wrong, when the trade goes against you, you're going to lose more. Okay, that's a trade-off. There's no way around it, but it's important that you understand the trade-off whenever you're trading these strategies. Now, I know why I created this. So lower and better is still actually correct. So when you're selling these credit spreads, you can sell what we consider near the money options, or you can sell really far out of the money options. So when you sell near the money options, you're going to have lower probability of profit. This is what I would consider more normal when it comes to selling a credit spread, but I'll show you a few examples later where you can really seek really high probability trades. And I unfortunately see a lot of traders try to seek these really high probability of winner trades because they think that, well, if I can win 90% of the time, that'll be better than winning 67% of the time. But again, when you're doing that, you're missing the other half of the picture. Many of the times when you're seeking these really high probability trades, you're risking many times much, much more than the actual outcomes that you're really seeking. So if you have 90% winners and you win 100 crowns each time, then what happens is you win 900 crowns on your first 9 trades, and you have one losing trade where you lose 1,500. How much do you make on this whole trade at the end? It's not a winning scenario. You actually end up losing money. So don't go out there and seek these really high probability trades, because many times what you're going to notice is that, yes, you win all the time, you win small amounts. That one time you lose money, you blow up your entire account. So it's really important that you seek, relatively lower probability of profit trades on these types of strategies, even though they're still relatively high compared to buying a call and buying a put. Does that make sense, everyone? Please type 6 into the chat window if this makes sense to you. Okay, perfect. So let's talk a little bit about the optimal credit spread. The optimal credit spread is, generally speaking, where you're selling shorter dated options. And this goes back to the intermediate course that we had on selecting optimal expiration dates and strike prices. Whenever you're selling options, you generally want to sell shorter dated options. 4 to 6 weeks out is usually a good starting point. And what we sell is usually a 50 delta call or a put. So the at the money call or a put is a good starting point. That's why on the 1660, we would sell the 1660 put or a call, regardless of whether we're bullish or bearish, the at the money call. And then what we want to do is we want to buy back a call that's roughly about a 25 delta, have about a 25% chance that the stock or index will hit that upper or lower strike by expiration. And if you use this type of strategy, what you're going to find is that you're generally going to collect roughly 1/3 of the distance between the 2 strikes. So we talked about the distance between the 2 strikes. So for example, in the put credit spread, we were trading something with about a 75 point credit spread. The call credit spread, we were looking at something with a 70-point credit spread. So the distance between the two strikes is the amount of capital that's at play. And what you're trying to collect is roughly 1/3 of the width. So if you have an option that's roughly 70 points wide, what you want to always try to collect is roughly 1/3 of the width. And then what that means is that you're leaving 2/3 as the risk on the particular trade. So that's the general ratio that you want to try to achieve on these types of strategies. And when you do that, you're going to see you have roughly about 67% of your trades are winners, and you're going to risk roughly 200 crowns for every 100 crowns in risk that you're actually taking. So we made a chart here a little for you to remember, because again, when we're thinking about credit spreads, we always think about the width of the credit spread first, and then what we look to see is how much of the width are we actually collecting in terms of credit. So if you're looking at a 10-point wide credit spread, you want to collect at least 3.33 crowns. If you're selecting a 50 crown credit spread, you want to collect at least 16.67 crowns. So roughly 1/3 of the width is what you want to collect whenever you're selling a credit spread. Okay, does that make sense, everyone? Please type 7 into the chat window if this makes sense to you. Okay, perfect. And lastly, how to manage these trades. So once you're in a credit spread, how do you actually control that spread? Number one, we talked about you want to time these when you expect the market top or bottom. So once you're in this particular trade, the goal is to let the spread expire worthless and keep the credit. So in that put or call credit spread, when we collected 25 crowns or 30 crowns, the goal is for the entire spread to expire worthless so that you keep the 25 crowns or the 31 crowns and you let both legs expire worthless. Now, there are times where you're going to be able to take profit early, and you want to do this if you've collected 50% of the gain with more than half the time left to expiration. So in the put credit spread before, we were selling it for about 25 crowns, and it was roughly, I think at that time, let's just say it was 4 weeks away. Okay, so I've sold a 4-week credit spread for 25 crowns. What that means is that if, let's say, there are still 2 weeks left to go, and I've made half of the amount of this, so let's say I made 13 crowns in terms of profit out of my 25 crowns, that is a good time to take profits on the particular trade, meaning you can hold the other 2 weeks for the other 12 crowns, but our research and our backtesting shows that that's not always the best idea, because one of the things that you have to consider is the fact that you actually start to have a significant amount of gamma risk heading into the last 2 weeks. Yes, theta is going to work faster in the last 2 weeks, but what happens is gamma risk starts to outweigh the increase that you get in terms of theta or the time decay. Now, I don't necessarily have enough time to get into the details of that research, but it's important that you understand that when you have the opportunity to take 50% of the gains and you still have more than half the time left to go, take those profits, roll that profits into the next trade. It's not worth holding it to expiration. Now, if this trade, on the other hand, goes against you, that's really where it's a little tricky to determine when you should cut your losses. Now, there are 2 scenarios. If the credit that you receive is greater than 20% of the vertical width, and remember, the strikes that we're showing you, you're collecting 33% of the width. So that's the case for this, right? So all the scenarios that we've talked about is when you're receiving greater than 20% of the vertical width. You want to cut your losses at 75 to 100% of the premium collected. So in the 25 crown example, right, where we collected 25 crowns, we know our max loss on that is 50 crowns, right? We know that the most we can lose here is 50 crowns, but we don't want to get to that point. Well, generally, if you've collected more than 1/3 of, more than 20% of the width, what you generally want to do is once you reach 75 to 100% loss, so when this is down about another 25 points, what you want to do is you want to cut your losses. You don't want to lose 50 crowns, because if you lost 50 crowns every single time, you're really going to, this strategy is going to underperform if you have the full loss every single time that you take a loss. What you generally want to do is you want to, by the time that you've lost 100% of the premium that you've collected, or half of the total max loss, if you are able to cut your losses at that point, what you're going to be able to do is come out ahead in the long run with this type of strategy. Now, the difference here is that sometimes people don't always follow the strikes that we tell you. People tend to gravitate towards selling those higher probability of profit strikes. And what you'll find is that the higher probability of profit strikes, you're going to collect less than 20% of the vertical width. So if, let's say I have a 75 point credit spread, and let's say instead of collecting 1/3, let's say I only collect 10 crowns, right? And I'm risking 65 crowns in this particular case. And many times people will say, why would you do that? It's because sometimes this might have, 75% probability of profit. A lot of people, what they do is they forget how, the risk to reward ratio, and they focus too much on just this one number, because sometimes we think, oh, if we just win a lot, we'll make money in the long run. The answers to that, the reality of that is that that's not true at all. The reality is that many times this is very misleading, and what it hides is how much risk you're actually taking to achieve this 75% probability of profit. But if you do choose these types of strategies, I do want to cover it so that you understand how to take losses here. Generally speaking, what you want to do is 100 to 200% of the premium collected. So if you collected 10 crowns and you find that you're down roughly 20 to 30 crowns out of the 65 crowns, that's when you want to cut your losses. So it all comes out to be roughly half of the total risk that you're taking. Whenever you're risking half of that, or when you've lost half of the max risk, that's usually a good point to start getting out of that trade. So that is a brief summary of how to manage these credit spreads. So like I said, this is a more advanced strategy. This involves a lot more, a much deeper understanding, in my opinion, of option strategies. It involves a deeper understanding of managing these types of trades. You have to have some experience trading spreads, being able to get in and out and calculating your profits and losses intraday, and looking at your unrealized losses. So this is why this is the strategy that's part of the advanced option strategy course. It's important that you understand these concepts before you start trading these strategies in your account. So with that, what I want to do is I want to give you a couple of examples and just show you how you can utilize OptionsPlay to take a look at these types of strategies. So I'll take a look at OMXS30 real quick, which has declined quite a bit here today, 2.5%. Certainly looking a little weak, not just the OMXS30, but global markets across the US, Asia, Europe, US, all down at the moment. US markets are down about 2.5% right now. So if, let's say, I'm looking at some bearish strategies here on OMXS30, yes, I can buy this put option, which cost me 5,700 crowns to buy it. What I'll do is I'll show you selling a call credit spread and see how these two strategies come together. So it's trading at 1640 now. Before I was selling the 1730, so maybe I'll sell the 1710 or 1720 right now, just so we can see. So the difference between these two strikes, 1640 and 1710, that's 80 points wide. So the distance between these two strikes are 80 points. So on an 80-point credit spread, what I'm trying to collect is roughly 1/3 of that. So if I take that, I'm looking to collect roughly 26.4 crowns here. So here I'm collecting 35.75 crowns. So that's way more than the 1/3 of the width. So this is a good credit spread to look at, because I'm collecting more than 1/3 of the width. And when I collect more than 1/3 of the width, what happens is I've reduced my risk here. So I'm not risking 2 to 1 here. I'm risking actually very close to about 1.3, 1.4 to 1. So this risk reward ratio is actually really good. Versus if I bought a put, I'm paying 5,700 crowns. So now the index needs to move down to 1593 in order for me to make money on this particular trade. 1593 is all the way down here. So OMXS30 needs to decline below that level in order for me to make money. versus this call credit spread, as long as the stock stays above, or I'm sorry, below 1675, which is right here, 1675 is right here, but the index is currently trading at 1642, which is right here. So if the market goes sideways, if the market goes a little higher, if the market goes lower, I make money in all of those scenarios. So let's compare these three strategies side by side. So if OMX S30 stays at around 1640, by the August expiration. Notice that if I bought the put or the put vertical, both of these strategies, I would lose almost entirely my entire investment here, roughly $7,200 loss on the put, $4,700 loss on the put spread. Not a good outcome if the stock stays the same or index stays the same, right? Versus the credit spread, I collect the $3,500 in credit. So strategies, again, when you're neutral or mildly bearish, this is the strategy to make. So even if the index moves down to, let's say, 1625 or 1600, notice how this strategy will make a profit versus these other two strategies will actually lose money. So that's the challenge of options, right? Is that you can actually get the direction correct. So in this particular case, the index falls by 40 points, but you still lose money. That's not a good feeling to have, is to call the direction correct and then lose money because you traded a suboptimal trade. And this happens all the time with options trading. If you're not using tools like OptionsPlay and you're able to compare strategies side by side, is that you're not really sure that you're trading the most optimal strategy for the outlook that you have. So you need to make sure that you understand what your outcome is and how much money you would make or lose based on that outcome. Now, if you do think the market's going to make a big move to the downside, let's say you think it's going to move down to, let's say 1460. Now, as you can see, that's when this strategy is very suboptimal. Yes, you still make money, but you only make the 3,500 crowns. If you bought a put option, you'd make 10,000 crowns. If you bought the put spread, you'd make 13,000 crowns. Would you rather make 3,500 or 13,000 crowns? So again, it's so easy to trade the suboptimal strategy if you're not comparing it side by side. And you can use this tool to see, well, at what point does one strategy start to outperform the other? Because that's how you can determine, should I buy a put or a put spread? Or should I sell that credit spread? You shouldn't just always sell options. You know, I tend to find that there are some users that just like to always sell options because they prefer selling options. But as you can see, if you always do that, there will be some scenarios where you will be giving up a lot of potential gains that you could have received that you just didn't. And guess what? The two strategies risk roughly the same amount of capital. This risk 4,400, this risk 5,700, but would you rather risk 5,700 to make 14,000, or would you rather risk 4,400 to make 3,500? I certainly would rather prefer this strategy here on the right-hand side if I believe that OMX S30 is going to make a big move to the downside. So even though I taught you here a strategy that's very forgiving, that's very versatile, that has high probability of profit, it's still important that you understand when is the best scenario for it, because again, there are many scenarios where you are better off trading a different strategy, okay? Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you. And I'll just do one more example before we open this up for Q&A. I just want to show you some more examples here. So I was looking at this particular stock. This stock, you know, really has struggled here within this particular trading range. So this is the prime example of a stock trading within a range. And when it's hitting on the top of the range, you might want to sell a call credit spread here. So I'm going to compare these three strategies again. I'm going to sell a call credit spread here. So let's say I trade a 1360 400 point credit spread. So the distance between these two strikes, 40 points wide. So on a 40 point wide credit spread, how much do I want to receive? Roughly 1/3, which is 13.2 crowns per share. Here I'm collecting 15.25 crowns, so more than 1/3 of the width. That's the type of credit that I'm looking to receive. Now, when I'm trading this, as you can see, now let's compare these three strategies side by side. So Bald B is trading at 361. So let's say the stock stays within this range and it doesn't really move much lower and stays around 360. So I get the direction relatively correct, but if I sold the put credit or the call credit spread, I collect the $1,500 that I'm receiving on the call credit spread. If I bought a put option, it'll cost me 3,400 crowns, which means that the stock did not decline far enough for my put option to be profitable, so I lose money. Same thing on the put spread. Even though it cost me significantly less than the put, it still doesn't cost cheap. It's not cheap enough where if the stock doesn't move, I can make money. So I actually lose money if the stock moves just a little bit lower. And even if the stock moves down to 345, which is at the bottom of the range here, 340, as you can see here, I'm actually losing 450 crowns on the put, and I only make 550 crowns on the put vertical. So even if the stock gets back to the lower end of the range, buying a put option doesn't make sense because I'm only making 550 crowns while risking 2,500 crowns. That's not the type of risk to reward ratio that I'm looking for. Now, if you are more bearish and you think this can go down to maybe 300 or 310, that might be a different story, because as you can see here, even if you think the stock's going to go down to 310, this strategy will become far more profitable. For roughly the same amount of risk, here I'm risking 24.75. Here I'm risking 24.50. So I'm actually risking less money on this particular trade. So as you can see, these two trades are risking the same amount of capital. It really just depends on where do I think the stock's going to end up. If I think it's going to end up relatively close to the current price, you're better off selling the credit spread. If you think it's going to make a big move to the downside, you're better off buying the debit spread because you're giving up a lot of potential profits if you're selling versus buying. So that's how you can use OptionsPlay to set up these types of strategies side by side. And I just want to show you here, right? So here I'm risking roughly 1.5 to 1. And I have about a 62% probability of profit here. I just want to show you what you can do. You can choose these really high probability of, so for example here, if I sold a 400 to 460 call spread, so these are really far out of the money, and I have a much higher probability of profit here, about 82%. But as you can see, I'm risking $3,600 just to make 375. So I'm risking almost 10 to 1, even though I'm an 80% probability of profit. So 80% probability of profit means that I should win roughly 4 out of 5 trades. But if I win 4 times and I win 375 each time, how much money is that? 375 times 4 is roughly $1,500 in terms of gains if I win that 4 times. But what if then I lose that 3625? Guess what? Now my total trade is I'm down negative 2,125 crowns. So this is just a warning sign, right? Be careful. I see too many investors when they're selling credit spreads only look at this one number and they say, oh, I want to sell something with high probability of profit because the higher that number is, the better it is for me. That's not true at all. Many times, the higher the probability of profit, the worse the trade actually is. So be very, very careful when you're looking at those types of strategies. Does that make sense, everyone? Please type 9 into the chat window if that makes sense to you. Perfect. Okay, so that covers what I wanted to show you here today. I really hope that you guys find this useful in helping you better understand the strategy itself. I hope that this inspires you to consider looking at credit spreads as a way to trade when you have a mild or direction or neutral view on an underlying stock, because many times as stock investors or even options investors, we don't think about how do I make money if I think the stock's just going to stay where it is. Credit spreads are one of the ways that you can utilize it. I hope that this showed you how you can utilize credit spreads responsibly and not do so in a way that could blow up your account, really avoiding those high probability of profit credit spreads that many people tend to gravitate towards. Stay away from those. Those are what's likely going to cause you to blow up your accounts. And I hope that this inspires you to see how you can really construct different strategies together, buying some options, selling some options, and combine them in different ways that gives you the outcome that you're really looking for. And there are so many more. This is really just the first step, in my opinion, in your learning process if you're in the process of learning how to trade options. So thank you so much, everyone, for taking the time out here this evening to listen to me. I know it's summer and I know people like to get out. and go on vacation and spend time with their family. So I'm really, really grateful that you guys spend your hour on Wednesday evening with me learning more about options trading. And I hope that you guys were able to learn something here today. So just a reminder, for those of you that have not signed up for OptionsPlay, everything that I just showed you, the platform, the weekly education, this is all available to you free of charge, courtesy of NASDAQ. NASDAQ has paid for you guys to access this. You just have to sign up using the link at optionsplay.se, which is on the screen. And I just posted it into the chat window. This will give you access to the platform. It will give you access to the education that we do. There's a video library that you can go back and watch the beginner courses, the intermediate courses, and all of the recordings, even the advanced courses, are all there. So regardless of what you're looking to learn, we have a whole lot of resources that are available to you, all free of charge. Just please register at optionsplay.se. And for that, I just want to again thank you everyone for taking the time out here this evening. At this point, what I'll do is I'll open this up for Q&A. If you have any questions, feel free to type them into the chat window. Looks like there's already a question here from Kristen asking, can I watch your previous webinars anywhere? Absolutely. So I will post the link here to looking at we've created this whole website for all of our education. So all of our educational courses are right here. So you can click on that. I'll post a link here. Under the education section, there are educational courses and there are webinar recordings. There are even short videos. And for those of you that prefer your language in Swedish, these are all available, and it's all at the link that I just sent to everyone in the chat window. Looks like there's a question here. How should I think when choosing the width of the spread? Any more rule of thumb? So the rule of thumb here is really using the 50 delta and the 25 delta as your starting point. So 50 delta, you always want to sell an at the money call, and then you want to select a strike price to buy that will give you roughly 1/3 of the distance between the two strikes. So you can really experiment, right? So even if you don't know which strikes to sell, what you can do is you can go to your platform, right? Let's see, 1 second. So even if you have no idea what to buy back, right? So what you can do here is you can sell, let's say the at the money, which is the 1360. And what you can do is you can, as you can see, 1370, at 1370, you're collecting 250 crowns for a $10 wide credit spread. That's only 25%, not quite enough. You go to 380, you're collecting 750 for a 20-point wide credit spread. That is 1/3 of the width. So that's suitable. You can go to 1390. You are also collecting roughly a little bit more than 1/3 of the width. So all of these are suitable credit spreads to sell. What you're really looking for is a risk reward where you're collecting at least 1/3 of the width of the credit spread. Generally speaking, you don't want to go past one standard deviation. So you can really experiment, and the wider the spread, the more risk there is. The less income there is also, but the more risk there is. So you can really experiment with this. I just chose the 360-400 because I usually like to trade something that's about 10-15% out of the money for my credit spreads, but you can experiment. There's different, there's no hard and fast rule on this, but you always want to make sure that you're collecting at least 1/3 of the width. Tobias is asking, are the slides also available on the EDU page? So the slides are not available on the EDU page, but that is something that we can potentially add, Tobias. We do send out the slides with the recording that we email out to you. So we send out the email every single time we finish, usually either the night of or the day after, and we always include the links in the email. So please look out for the email after we finish here today. Any other questions? I know I covered a lot here with you guys today, but it is very important that you understand the nuances here because credit spreads, they're not the easiest to understand. It's important that you understand those concepts that I refer to here today to help you avoid some of the pitfalls that can come with credit spreads. If there's a comment here saying that I never get the emails with the presentation. If you don't mind sending me an email at info@optionsplay.com with your email address, I'll look into your account and see whether or not you're added on the list. Sometimes you may have unsubscribed and that's why you're not receiving them. So if you send me your email at info@optionsplay.com, which I will post into the chat window, just so you have our email, send me an email with your email, and we will look into your account and see if perhaps you have unsubscribed. If you have unsubscribed, we can re-enable your account so that you start getting those emails. Great. Any other questions about credit spreads? And you know, we have seen a lot of unsubscribes. So if you find yourself in a position where you may have accidentally unsubscribed, or if you want to get back on the email list so that you get these links and these recordings, please feel free to shoot us an email at info@optionsplay.com, and we can look into your account and re-enable your email communication. Any other questions? There's a question here: credit spreads. What do you say about what do you say about taking one leg at a time, depending on what it will look like? Generally speaking, these types of strategies are not strategies that you want to trade one leg at a time. First of all, the reason for it is because you don't want to ever put yourself in a position where you're just short an option without the long leg. And many times you also don't want to be long the option without the short leg. So generally speaking, I don't recommend that you trade these separately. If you are a very experienced options trader, I do tend to find that there is some merit sometimes when a trade goes against you that you close out the short leg and that you keep your long leg, but that is a very tactical play, and in my opinion requires you to have a very strong understanding of each individual leg and how they react to the market. And if you feel that's the case, you certainly can, but more so that's more on the exit side rather than the entry side. Kristen is saying, not really about credit spreads, but I guess it could be. I recently bought 1,800 OMX call options. Now it's gone down to 1,650. You reckon I should sell to not lose too much? It doesn't finish until September though. So, you know, I will say, it depends on how much you've lost on that call option. If you've lost more than 50% of what you paid for that call option, then I certainly think that it's time to get out. You know, September is not that far away. It really depends on how bullish you think the markets can continue to move. You know, I certainly think that a lot of the momentum in the market has been taken out from the last couple of weeks. We certainly have seen a lot of weakness going into today. The question is whether we're going to continue this weakness for the rest of the week. If we finish this week, if we finish the rest of this week on the weaker end, then I certainly would also consider getting out of that trade, even if you haven't hit the 50% threshold, simply based on the directional view of the market. But generally speaking, you paid 33 and now it's at about 20. So you haven't quite reached the 50% loss mark, but that's usually the threshold at which I would cut my losses and move on to the next trade. So if it goes down another 6 or 7 points, you know, it goes from, sorry, if it goes down another 5 points or so, then that would be about time for you to consider cutting losses on that trade. Feel free to ask questions, even if it has nothing to do with credit spreads. Anything to do with options, feel free to ask. And I am going to be hosting an Ask Me Anything, for those of you that are familiar with that, on Reddit next week, next Wednesday. I will invite everyone. For those of you that are interested, you will also have the opportunity to submit questions ahead of time. If you want to ask me anything, this is not just related to options. You can ask me literally anything that you can think of. I'll be answering those questions live next Wednesday. So I hope that's to see some of you there, and I hope that some of you are going to be submitting questions for that. Anything else before I sign off here? If there are no other questions, again, I just want to thank everyone for taking the time out here this evening during your summers. I know you have better places to be. So thank you so much for taking the time out here to learn more about options trading. And really, you know, I love doing this and making sure that you guys understand how to utilize these strategies correctly for your portfolio and making sure that you guys have the tools to be able to implement this in your portfolio. So thank you so much. I hope you guys have a great evening, and I'll see you guys here next time.